I have some good news for you. You probably won't always be poor.
Well, I'm in my third year studying law. After university, I'll be at law school for a year, and that's quite expensive.
So the whole thing's quite expensive?
Very much so, yeah. It is notoriously one of the most expensive courses to do, but then the career prospects at the end of it and the amount of money that you'll get paid at the end is considerably higher than your average job. So it's a choice you make and a sacrifice you make, like an opportunity cost kind of idea.
Now, your current poverty is the subject of a later film in this series. But most students who graduate finish up earning a higher than average salary, enabling them to pay off their debts. And at that point, you may want to think about saving. But in what form will you save? Well, you might want to buy your own house. It won't give you an income explicitly, but its capital value may increase over time. And by not having to pay rent, you're receiving an implicit income. Shares in the stock market are another obvious possibility. The company pays its shareholders out of the profit it makes, so if the profits are good, you'll get some income in the form of dividends. You'll also find that others will now wish to buy the shares, and the demand for them will bid up their price, so the value of your financial asset will have increased. But buying shares in a company means becoming part owner of the business, so if the firm fails and the firm is worthless, you'll lose your savings. Even if the firm doesn't go bust, it may do poorly, and the value of the shares may be less than when you bought them. It's less risky to keep your savings in a bank account, but the interest the bank offers you may well be low, so your savings won't grow very fast, if at all.
A middle way is to buy bonds. When governments spend more than they receive in taxes, they sometimes fund the difference by issuing bonds, pieces of paper that you can buy, and the government will then pay you a rate of return on it. Now, it's a fairly low-risk form of investment because the government has never defaulted on its debts. But it's not entirely without risk. When you come to sell your bond, you may not get back for it all that you paid for it.
Now, there are other forms of saving than the ones we've mentioned, but these forms give us an insight into what we might call the risk-return trade-off.
The higher the rate of return, the greater the risk that you have to accept. So you have to make your own decision as to what level of risk you're willing to bear. Can you give us a definition of what you understand to be risk?
I would call risk volatility over time. I guess how much up and down swings you can stomach over a period of time.
Right.
Okay. That's what is the risk of you losing money over the next year, over the next 2 years, over the next 5 years?
Why would I be willing to undertake risk? Why don't I just stick to something which is much safer?
It's the risk returns ratio. You can go into cash at the moment and you get 0.5% or less, or you can put it on the stock market or in certain bonds and get 7 to 10% returns. So it's the old risk return. The higher risk you take, sometimes, not always, you get greater returns.
Diagrammatically, your choice will look something like this. The sketch shows an increasing level of risk as we move along the x-axis, an increasing mean average rate of return as we move up the y-axis. So the mean average rate of return tends to increase if you accept a greater level of risk. Remember, this is an average, so if things go wrong, you may lose part or all of your savings.
There are other forms of saving which follow the same principle. You can get other companies to invest on your behalf. Financial companies who will take your money, invest in a range of bonds and shares and so on. But they're not all equally risky. Some specialise in investing in risky funds, some in relatively safe funds.
Risk is all relative, and no one knows what the stock market's going to do. If they do, they're lying. There's a lot of behavioural science behind it, and herd mentality and various things that influence it and create a lot of noise behind it, so it never actually does. You never actually know exactly what it's going to do. There are good investments and bad investments. There's high-risk investments and there's low-risk investments. You can get very good, relatively safe companies, which are extremely well run, which over time will make money, but there will be up and downs along the way.
Even where two funds have the same proportion of shares, the risk can vary quite considerably. Some kinds of shares are much more risky than others. So for example, funds in America and the UK would be safer than funds in emerging countries. And even within an economy, riskiness tends to vary. So for example, it's much safer to invest in, say, an electricity company than it is to invest in a drugs company.
Traditionally, the larger companies are seen as safer, tend to pay good dividends, and then the smaller companies, the more startup companies, are generally considered higher risk because they're smaller, they might have less of a track record, and could potentially, there's more risk of them losing to competitors where they wouldn't, because they don't have the barriers to entry, they don't have the massive market share. But as with everything, there's caveats.
So how will you choose to save? Most people are risk averse. The hurt from losing money is greater than the pleasure from gaining the same amount. Let's test to see if you are.
I've got a playing card which could be red, it could be black. I'll offer you $100 if you guess right, but you've got to give me $100 if you guess wrong. Do you want to play the game? If you do, we would say that you are risk-loving. If you don't care, you are risk-neutral. If you don't want to play, you are risk-averse. You've got a 50% chance of gaining 100 as well as a 50% chance of losing it. Would you play the game?
No.
I'd say no thanks.
Okay.
I don't want to take the risk of losing money.
Because I'm not going to risk $100 on chance. It's a 50-50 shot.
Because I wouldn't want to take the chance to lose $100.
It impacts me more if I lose than if I gain.
The reason why we think most people are risk averse is because the loss of $100 has a bigger impact on their welfare than the gain of $100.
But how can we measure the riskiness of investing in funds? We can do it by using the important statistical ideas of the variance and standard deviation. Let's consider two different funds that people might invest in and see how they've performed over a period in giving a return to people on their savings.
Of course, past performance isn't necessarily a guarantee of what's going to happen in the future, but we can use past performance as an indicator of the likely risk of an investment fund. So we'll take an example and look at two such funds and see which one you'd prefer.
We have the returns that each has produced over the past 10 years, and we'll now make a comparison between them. Here are the returns that each fund, Fund A and Fund B, has made over the last 10 years. It's easy for each fund to work out the mean average return, X bar. For A, we sum the row to get 140, divide by the number of years, 10, and we find that X bar is 140 divided by 10 equals 14%, the average rate of return to the fund. Repeating the process for Fund B, we find X bar for that fund to be 120 divided by 10, which gives us 12%. So Fund B has tended to offer a lower rate of return over the years, but is it less risky?
So let's work through the formula. You may think it's a waste of time when you could do this using a spreadsheet, but it's not a waste of time because if you work through it manually, you understand what the data is showing you. You can interpret the result you get. So let's look at the standard deviation formula and then apply it to our fund.
We take the difference between the value of each year and the mean, that is to say X minus X bar. Step 2 is to square these differences, that is, x minus x bar squared. Step 3, we sum the squared differences. In other words, that gives us sigma x minus x bar squared. Step 4, we find the average of the squared differences. This is the variance sigma squared. So that's sigma x minus x bar squared divided by n, which in our case is the number of years 10. Step 5, take the square root of the variance, so that gives us the square root of the sum of x minus x bar squared over n. So now we can calculate the standard deviation for Fund A. The first column gives the individual return in each year. The second column gives us the mean average return, x bar. It's an average. It's the same for all years. The third column is the difference between x and x bar, x minus x bar. So in year 1, 12 minus 14 gives us minus 2. Year 2, 18 minus 14 gives us plus 4, and so on. In the fourth column, we square these differences, x minus x bar squared. So for year 1, minus 2 times minus 2 gives us plus 4. For year 2, 4 times 4 equals 16, and so on for the 10 years. Now we take the sum of the squared differences, sigma x minus x bar squared, and that gives us 216. Now the variance, sigma squared, is 216 divided by the number of years, in our case 10. 216 over 10 gives us 21.6. Now we can find the standard deviation, which is the square root of the variance. That is to say, the square root of 21.6. And that gives us 4.65. So the standard deviation for Fund A is 4.65%. You might like to check that the standard deviation of Fund B comes to 1.61. The greater variations around the mean for Fund A, the higher number for the standard deviation, might suggest that Fund A has the greater degree of risk. But using the standard deviation in this way has a problem. The higher number could simply be because the mean average is higher. This might not be obvious, so let's look at another example to make the point clearer. Then we'll come back to our investment funds. This chicken processing plant is one of the largest in Central Europe, supplying chickens in Greece, Turkey, Bulgaria and Romania.
They're the biggest producer on Bulgarian market, and they have about 60% of the market share.
It processes 8,000 birds per hour, and in a typical month, about 1.2 million of them.
You don't always get exactly the same level of output each day. Most days it's about the same. Some days it's a bit less, sometimes it's a bit more. Why does it vary? Because some days the chickens aren't ready, and so output tends to be lower. Other days demand is very high, the chickens are available, they work overtime, and output levels are greater.
Using the same formula that we used for the investment funds, we can find the standard deviation of output, which turns out to be about 180,000 chickens. By contrast, this truck assembly plant puts together about 16 trucks a month. The availability of parts and fluctuations in demand means that the standard deviation of its output is around 3. So the standard deviation for the chicken processor is 180,000. For the truck assembly plant it's 3. Does this tell us that variations around the mean are vastly greater for the chicken processor? Not necessarily. Variations in chicken processing are bound to be absolutely greater because the numbers are so much higher. But it's the proportionate variations that are important, not the absolute number. Fortunately, we can deal with the problem and calculate the proportionate variations very easily by calculating a coefficient of variation. The coefficient of variation, CV, is simply the standard deviation divided by the mean. So for the chicken processor, the mean number of chickens processed monthly was 1,200,000. The standard deviation was 180,000. So the coefficient of variation is the standard deviation divided by the mean, 180,000 over 1,200,000, which gives us 0.15. Now for the truck manufacturer, the mean number of trucks assembled monthly is 16. The standard deviation is 3. So the coefficient of variation is 3 divided by 16 equals 0.19. So despite the sizes of the standard deviations, there are relatively larger fluctuations around the mean for the truck manufacturer than for the chicken processor. We only discovered that by finding the coefficient of variation. So having established the principle, we can now come back to our investment funds and ask which one is more risky, which one has the larger coefficient of variation of returns. So for Fund A, the mean rate of return was 14, the standard deviation 4.65, so the coefficient of variation, CVA, is 4.65 divided by 14 equals 0.33. For Fund B, our mean rate of return, we calculated at 12. The standard deviation we found to be 1.61. So the coefficient of variation for Fund B is 0.13. So there are greater variations around the mean average rate of return for Fund A than for Fund B. On this basis, Fund A is the riskier fund in which to save, but it does give a higher mean average rate of return. The calculations don't tell us which is the right fund. That depends on your attitude to risk, but at least we've got some evidence on which to base a choice. You may feel too poor to think about savings just now, but you may not have to wait very long. As soon as you begin work, you'll be paying into a pension fund for your retirement, and someone on your behalf is using these concepts in making decisions. So we can now see how the use of the mean average, the variance, and the standard deviation are useful tools in financial decision making. But along the way, we've seen that it's not just in financial markets that these tools can be used. They apply, as we've seen, to industrial processes too. But in the course of study, you'll also find many other examples of the application of these concepts right across the social sciences.